Okay, this is an example of effective interest and how it helps us to determine the price of a bond, the selling price of a bond, and how and also how to amortize the discount or premium. This case that we're going to do is going to be a discount on the bond when it's issued, and we'll amortize the discount. But if it had been a premium, it would work exactly the same kind of methodology. It would just be extra that had been paid for our bond instead of a lower amount. And so it works very similar. But anyway, this one is a situation where we have the data set here. The problem wants us to calculate the present value to determine the selling price of the bond. So what we have to do is calculate the present value of the lump sum that's going to be due at the end of the bond term, and then add that to the present value of the stream of payments that's coming during the time of the bond. And that is the annuity that is for the same amount of interest each period. So we've got a $50,000, 10% 3-year bond, and we have interest payments of $2,500 every 6 months. They didn't have to tell us that the interest payment is going to be $2,500, because if they just said $50,000, 10 years and 3 years, if they tell us it's 10% and 3 years, sorry, and they told us it was semi-annual, we could come up with the interest payment, because all you do is take the 50,000 times the interest rate of 10% that they're going to pay in interest, and then multiply it times half a year, 6/12. So that's how they got the 2,500. The market interest rate is 12%. So in a problem like this, where you are determining the selling price, they will have to tell you what the stated rate is on the bond that's on the face of the bond, and that's the exact amount that's actually going to be paid in interest each pay time, which is usually semi-annual, but it could be an annual interest payment. But in this case, it's semi-annual. So every 6 months, it's going to pay this $2,500. That's because the stated rate is 10%. And so the problem will also have to tell you, besides the stated rate, we'll have to tell you the effective rate, also known as the market rate, or it might say that the current rate, or that other institutions or other organizations are paying this higher rate or lower rate. So it's just going to be clear that it's not the rate that's being paid on the bond, but it's the rate that others are offering bonds. Okay, so in this case, we have a market rate of 12%. So for a semi-annual period, that would be 6% that others are willing to pay. So right off the bat, you know that we're going to be selling at a discount, because we're only offering 10% annually, and others will be willing to pay 12%. So we know it's going to be a discount. If you calculate everything and it comes up with a value of higher than 50,000, you know you've got an error. If your rate that your bond, our company's bond, is offering is lower than the market rate, it's not going to be more than the face amount. It's going to be less. Okay. So the first thing we're going to do is we're going to look at the 50,000 and we're going to discount it based on the market rate. So when we look at the table for present value, for looking for a factor, we're always going to be searching for the market rate. All right. So what we've got is it's a 3-year bond, and it's semi-annual. So there's going to be 6 periods that we're going to be looking for. So I'm going to just highlight the 6. And then the rate we're looking for is 12% annually, because that's what the effective rate is, which on a semi-annual basis equates to 6%. So we split the interest rate, the effective interest rate, and we double the periods when it's semi-annual. So now, once we know the period and the interest rate, then it becomes a piece of cake to use this table. We're looking for only one number. We're looking for the factor that is at the intersection of the number of periods that our bond is for and the interest rate that this bond is for. So it's not a 12% bond if you're looking at a semi-annual payment, it's half of that. So we go down where 6% meets 6 payments or periods, and we get this factor from the present value of $1 table. There's 2 sets of tables under present value. What is present value of $1? That's for a lump sum that's somewhere in the future. And then there's present value of an annuity, which is for streams of equal payments called annuities. Okay, so we're going to use this factor, 0.70496, to determine the face amount of the bond. Multiply the face amount times that's the 50,000 times that rate that we just found. I don't want to go there. Let's go back one more and turn it black instead of have to find my black ink over here. Okay, got it. All right, so 35,248 is the present value of the face amount of the bond. I took $50,000 from right here, the face amount of the bond, times this factor I found in the present value table at the intersection of the percentage 6% and the period 6. So it's like you take your finger and go down from 6% and across from 6 periods, down from 6% and across from 6 periods, and where they intersect, that is the only factor you want on the table. And every time you go to the table, you're going for the market rate. If it's an annual bond, you would go for the full market rate that's stated. If you, not the stated, sorry, the full market rate or effective rate that they tell you, where if it's a semi-annual, you look for half that amount. Because every 6 months, it's going to pay half of the annual rate. Okay, so that's all you do to find out the lump sum, the present value of the lump sum. So now I need the present value of the stream of interest payments that are coming. The interest payment is $2,500 every 6 months, and it's coming for 3 years. So there's going to be 6 of these interest payments. That's how many periods there are. So we're going to go to the other present value table that is present value of an annuity. And we're going to go to the place where 6%, again, 6%, because again, it's the market rate, and 6 periods, because again, it's 3 years, but it's twice a year. So twice a year times 3 is 6. So the place where 6% and 6 periods intersects is the rate I want. And I'll look up at this table and make sure I'm in the right table. It says present value of annuity of $1. So that's what I'm looking for. I look for, once I get the correct rate, 6%, and the correct periods, 6 periods, that number where it intersects is the only thing I want from this table. And I see that the rate is 4.91732. I multiply that times the interest payment of 25,000, and that gets me to 12,293 for the present value of the interest payments. When I combine them, I have the selling price. It's going to sell for the present value of the combination of the lump sum that's going to be due at the end of the bond period and the present value of the stream of interest payments. So 47,541. All right, so I put that in a little spreadsheet down here, which is the same exact thing. All this just to make it clearer what I pulled from the table. When I calculated the present value of the face amount of the bond, I got $50,000 times that rate from the table to get a 35,248. And then I took the present value to calculate the present value of the interest. I took the interest amount of 2,500 and multiplied times the rate I found in the present value of an annuity table. And I got this 12,293. So the combination of the two brought me to the selling price of the bond. So this is exactly the same numbers I had on my schedule. This just spells out a little bit more in more detail how I calculated it. Okay, so we know that when we record this in our books, we're going to show the 47,541 as the carrying value of the bonds. And so first we're going to record the bond with an entry like this. It's going to say debit the bond, debit cash for 47,541 and credit the bond for $50,000. And then once you have these two, we're going to pretend we don't know how much the debit to discount on bond is. Of course we do. It's just the amount of cash, the amount we got less in cash than the face amount of the bond. But when you're making the entry, you debit the cash that you're selling the bond for, you credit the bond payable for the full face amount, and the difference between them is what you need to make this journal entry balance, right? You have a debit for cash, you have a credit for bond payable, but you need another debit. And that is indicating to you, that's just another way that's indicating to you that it's a discount on the bond. Because as we know, discounts are debit balance entries and premiums are credit balance entries, because we already talked about that in the lecture. This is just an example. So if you haven't already watched the lecture for chapter 10, please go back and do that. Okay, so that's the entry we would have made when we first issued the bond, debiting the cash for the amount that the bond sold for, crediting bond payable for the full amount, and then the difference is either a discount or a premium. If it's a debit, it's a discount. If it's a credit, it's premium. So on the balance sheet, these three numbers initially would represent the carrying value of the bond, and they would show exactly the same numbers. Bond payable 50,000, less discount on bond payable for 2459 to bring us to a net carrying value for the bond, or also known as a net book value of the bond, 47,541. Now, as you go along, they're not going to always be this amounts. Bond payable is going to stay constant at $50,000 until it's paid back. But the discount is going to slowly disappear, or fast, whatever. It's going to disappear over the same period of the bond, the same 3-year period. The discount is going to disappear because you're going to amortize the discount and adjust your interest expense with that amortization. So let me show you how that works. On the books, you start out with this discount on bond payable of $2,459, and you have the bond carrying value at the 47. So we start like this. This is an amortization schedule over here on the right. Right, you start with stated interest. All right, the stated interest on this bond was the $2,500 each time. It was the $50,000 bond at 10%, paying out twice a year. So that means the stated interest every period was the $2,500. It didn't change, and that's actually the amount they're going to write a check for interest every 6 months. So that is the part we know. So let's just see what happens when we pay an interest payment. Here is a little journal entry we're going to use. We're just going to do a couple of interest payments so you can see how it works. This is the interest payment journal entry right here. At the end of the period, or at the time the payment is due, I guess we should say, we have a $2,500 cash going out, and that's his stated interest. Every time we make an interest payment, it's going to be cash for $2,500 credited. And then to see how much the interest should be debited, we calculate the effective interest by taking the effective interest rate, which is the 12%, 6% each of the 6-month periods, and we multiply it by the current amount of the bond carrying value. So right now, at the initial stage, when we start to make the first payment, the carrying value is 47,541. So we're going to multiply that times the effective interest rate to get the effective interest. So 47,541 times 6% gets us an effective amount of 28.52. That's the interest expense we're going to debit, 2,852. So now when you look at it, you can tell clearly how much you amortized because you're looking at stated interest, you're looking at effective interest, and the difference between them is the amortization. So on your amortization table, it's very clear. Okay, amortization is the difference between the two calculations, the amount we paid out in cash and the amount that the interest would be at the effective rate based on the carrying value. So the other way you could do it is look at the journal entry. You need a credit to make this journal entry balance. I'm going to put this journal entry in another color so you can see. I'll highlight it. We have a debit of 28.52. We have a credit of cash for 2,500. We clearly need another journal entry for 352 as a credit. That is the amortization the discount amortization being recorded. So whenever we record that 352, it means that if you looked at a T account for discount on bond payable, it would have a credit balance, a debit balance originally and a credit from this entry we just made. You see the original entry had a debit of $24.59. So that discount on bond payable has a debit balance of $24.59 before we made our interest entry right here, the amortization entry. And so we're crediting it for $352. So we're reducing the bond payable. So if you had a bond that was at a premium or a bond that is at a discount, either way, the discount or premium is going to get smaller and smaller until it totally disappears at the end of the bond period. So this discount, remaining discount, we know is going to be decreasing, just like a premium would be. They're going to eventually turn to zero. So 2,459 was our original discount on bond payable, we just amortized or shifted over to affect the interest expense, $352 of it. So we're left with a bond discount of $2107. So now our bond carrying value is different. On the end, at the end of the period, our discount is $2107. So but at the end of the period, our carrying value would no longer be $47,541. Now it is $50,000 minus $2107. So the bond carrying value at the end of the period is $47,893. So as you go closer and closer to the end of the bond period, you wind up with the bond getting closer to its face amount. The carrying value of the bond is going to get closer and closer because its discount is going to disappear. So $47,893 at the end of this period. And each time you make an interest payment, it's going to increase the carrying value to closer to the bond face amount. If you had a premium, it would decrease the carrying value. But in any case, the premium or discount starts to dissipate, go away in both cases. And the carrying value is closer and closer to its face amount. All right, so just doing one more interest payment just to give you an idea. Now, the second year or the second payment of $2,500, we would say the interest amount is the carrying value of $47,893 times that 6%, again, $28.74. So this time we would debit interest expense for the $28.74. We would still credit cash for the $2,500 because that's what we're going to do every time. That's what we're actually giving to our bondholder. And the credit we need to make this entry is the amortization of $374. $374, you see, it's just a difference between the stated interest and the effective interest. So again, the remaining discount is decreasing by the same amount we just amortized. And by the same token, the bond carrying amount is getting closer to the face amount of the bond. So each period that each of these 6-month periods that we make this adjustment, we're just shifting a little bit of the premium or discount over to add to or subtract from the interest, stated interest, so that we will wind up having zero balance in any discount or premium account, and we'll wind up with the bond carrying amount being $50,000 at the end of the period. So whatever your face amount of the bond is, that after you finish with your amortization, that's what's going to be on the books. It's only going to say the words bond payable whenever you do your final, after your final interest adjustment. Okay. And that's all. It's really not that complicated. It's just a pain. And if you've never done it, there's almost no way to get there. You have to actually see the process of what it is we're trying to accomplish. And then it becomes, okay, I can do that. Okay, thanks.